Welcome back to A Smarter Way to Retire. I'm Tony Leonardi, your certified financial planner in Newtown, Connecticut, here to help you navigate the path to financial independence with confidence. Today we're going to tackle a hot topic, the One Big Beautiful Bill Act. Yes, that's actually what it's called. I know it's got a crazy name, but it was signed into law by President Trump on July 4th, last week. If you're currently retired or working your way towards retirement, this new tax law could mean thousands in savings, and it has some surprises as well. Will it boost your retirement nest egg, or do you need to pivot a little bit? Stick with me as we break down what this means for you, whether you're a business owner, retiree, or planning your legacy. And don't miss out on our free 2025 tax planning checklist at leonardifamilywealthcare.com. So let's dive in. So picture this, it's a massive tax overhaul, the biggest since 2017, and it's packed with changes that will hit your wallet, your business, and your retirement plans. The One Big Beautiful Bill, again, it's actually what it's called. I'm going to call it, for the duration of this podcast, the bill or this bill. It locks in 2017 tax cuts, adds new deductions, and shakes up everything from car loans to estate taxes. It passed with a razor-thin margin, 51-50 in the Senate, with the vice president breaking the tie. And it definitely has folks talking. Here at our house over the 4th of July weekend, people were talking about everything from tax breaks to deficit worries. For our clients, this bill is a mixed bag, I'd say. It's got some nice juicy tax savings, but some benefits fade away pretty fast, and there's a catch for certain professionals. My goal today is to make this as clear as possible so you can plan for smarter retirement. Let's start with the big changes and how they hit your bottom line. So the top tax law changes and what they mean for your retirement portfolio, taxes, and legacy. I'll use some examples to bring this to life, and we'll wrap up with action steps to make the most of this law. First up, in order to understand this bill, we have to go all the way back to 2017 and the 2017 tax cuts from the Tax Cuts and Jobs Act. Those tax cuts were set to expire at the end of this year, which would automatically have raised tax rates. Those tax cuts are now permanent, meaning there will be no tax hike in 2026, which is huge. Remember from last week when I told you that this bill it's not a tax cut per se, or cut in rates. It's just a cut of the tax increase, which was already baked into the law due to the sunset provision. So if you're a couple earning, let's say, $200,000, you're likely in the 24 or 32% bracket, and those rates are now locked in, saving you $2,000 to $4,000 a year compared to what could have hit. The standard deduction of $29,200 for couples gets a temporary $2,000 boost through 2028. So let's take, for example, Sarah and Mike. They're a couple in their 50s with $3 million in investments, $250,000 in income. They'll save about $3,000 annually because their tax bracket stays in place rather than increases. That's extra cash for their Roth IRA or for a dream vacation. So what should you do? Review your 2025 withholdings with your CPA to avoid overpaying taxes if you were planning on increases. If you use tools like the modeling software that we use, or if you do it on your own, look at your model, talk to your planner, and see how this will impact your retirement timeline. If you have a model with me, or if you've done one on your own, you should see a bump up in your probability of success due to the new tax law. Well, why is that, you ask? Well, as I explained last week, this law didn't necessarily reduce tax rates or cut rates, but it did hold rates steady, the same rates we've been paying since 2018. Without this tax law, taxes were set to automatically increase to pre-2018 levels, meaning that everyone in every bracket would have seen a tax increase next year. So the model that you've been using for the past few years had the 2026 sunset provision or the tax law increase already built into it, because that's how the tax law was written. So if you looked at your model a month ago, you would have seen a tax increase in 2026, an automatic increase. So as soon as your software is updated to reflect the new law, the automatic increase will be removed from your model, and you should see a nice little bump up in your probability of success. That's great news for everyone. So here's a big one for our clients in high tax states like California, New York, Connecticut, the SALT deduction cap. So SALT is state and local taxes and your federal deduction of those state and local taxes. So the SALT deduction cap, those state and local taxes you can write off, jumps from $10,000 all the way up to $40,000. And this will hold through 2029. As long as your income's under $500,000. But here's the kicker. If you're a doctor, a lawyer, an accountant, a consultant, or another white-collar professional whose business relies on reputation or skill, you're excluded. Tough break. I'm not sure why this is. I think maybe they were trying to help blue-collar workers more than white-collar workers. But either way, it is what it is. So let's take Lisa, for example. Lisa is a marketing executive in New Jersey earning $200,000. She pays $25,000 in property and state taxes. She can now deduct the full $25,000, saving $6,000 at the 24% bracket. But her husband, who's a lawyer, can't claim this on his firm's taxes. Maybe Lisa and her husband should look into filing separately. Talk to your accountant if you're in this type of situation. Remember, certain professionals are excluded. So if you're eligible, itemize your deductions to max out the $40,000 SALT cap. If you're in one of those excluded professions, let's find other write-offs like investment expenses or charitable gifts. Check out our checklist at LeonardiFamilyWealthCare.com for some tips. Next up, if you're a business owner, there's a larger Section 199A deduction. So if you have an LLC, an S Corp, or even a side job, side hustle, this is for you. The bill bumps up the Section 199A deduction from 20% to 23% of your qualified business income, and that's permanent. So that drops your effective rate to about 28.5%. Why'd they do this? Well, the purpose is to level the playing field for small business owners who don't benefit from lower corporate tax rates, which are at 21% for C corporations. So this tries to level the playing field a little bit. For example, John runs a real estate LLC, earning, let's say, $200,000. He can deduct $46,000 or 23% of his income, saving about $11,000 in taxes compared to the $9,600 before the increase. So there is some extra money there to reinvest or pad his retirement accounts. So if you're a business owner, work with your CPA to ensure your business qualifies and maybe consider equipment purchases, since the bill also allows you to write off those costs immediately. This could be a gold mine for growing your wealth smarter as a business owner. Next up, there were some changes in the estate planning, estate tax laws. For those of you thinking about your legacy, and I know that's a big focus for a lot of our clients, the bill makes the doubled estate tax exemption now permanent. So that's about $13.6 million per person, or $27.2 million for couples, which you can pass tax-free to your heirs. Here's an example. Maria and Tom have a $4 million estate. They can pass the entire estate to their kids without a dime in federal estate tax. That's a peace of mind for their family's future. So make sure you update your estate plan now, your wills, your trust, the works, to leverage the $27 million exemption. It could be a game changer for keeping your wealth in your family, especially if you're a business owner or even a farm owner. I've seen family businesses go under being sold just to pay the estate taxes. So plan ahead. Don't let this happen to you. By the way, when I started in this business 30 years ago, the estate tax deduction was $600,000. Imagine that. Kind of scary. So we're in a much better position today. Next up, car loan interest deduction. In this bill, This bill allows you to deduct up to $10,000 in car loan interest for U.S. made vehicles, which is fantastic, but it phases out for incomes over $200,000 for couples. Most of you earning, let's say, $200,000 to $300,000 won't see much here, maybe a few $100s if you're closer to the $150,000 level. So, for example, a couple earning $150,000 with $6,000 in interest on a Ford SUV could save $1,400. But if your income's up to $250,000, the deduction goes away. So what do? If you're in the lower end of the income range, consider buying a U.S. made vehicle, but do it before 2028 because this deduction phases out in 2028. Otherwise, focus on bigger savings like the SALT deduction or the business deductions. Next up, for seniors, there's an extra deduction. So we all heard this talk about no tax on Social Security. That didn't make it through reconciliation, but there is some benefit for seniors to help out a little bit. So there's a $6,000 tax break, but there is a catch. So if you're 65 or older, in this particular Big Beautiful Bill Act signed on 4th of July, there is a new tax break. A $6,000 deduction per person or $12,000 for couples on top of the standard deduction, which sounds great, right? This could mean more cash for your retirement dreams, but it's not a one-size-fits-all deal. So let's break it down a little bit. If your income's around $100,000 to $150,000, say, from Social Security and IRA withdrawals, you get the full $6,000 deduction, saving up to $2,880 for a couple at the 24% bracket. Picture my clients Tom and Ellen, both 67, with $140,000 in income. That's $2,880 to help cover healthcare costs or grandkids' college fund. But if you're earning $200,000 like Susan and Bob, your deduction drops about $8,400, saving $2,000. And at income of $250,000 or more, you're phased out. So this has a phase out for higher income earners. Plus, this break will vanish in 2028, so it's only going to be around for a couple of years. And it doesn't necessarily wipe out Social Security taxes, despite what some have hoped for. So if you're near the $150,000 adjusted gross income mark, tweak your IRA withdrawals or do some Roth conversions to stay under that limit. If you're phased out, don't sweat it. Lean on other tax breaks like the $40,000 SALT or business deductions. And with the bill possibly increasing the deficit, which some people fear, make sure you stress test your portfolio for potentially rising rates. Don't forget to grab our free 2025 tax planning checklist at leonardifamilywealthcare.com for some more information. So this senior deduction is a tool to help retire smarter, but you have to act fast before it's gone. Remember, 2028. Next up are clean energy credits, which are disappearing. Bad news for eco-conscious my green clients, which I have many. Tax credits for electric vehicles and solar panels are phasing out after 2025 through 2028. If you were counting on the $7,500 EV credit, you should probably act fast. Buy that Tesla or install those solar panels this year in 2025 to make sure you grab the credits while they last. So the big picture, this bill could add potentially $2 to $3 trillion to the deficit, which some people are talking about, which could push up interest rates, could push up inflation, could have an effect on your bond portfolio if you're heavily invested in bonds. But it is business friendly. It has business friendly rules like the immediate equipment write-offs, which could lift small cap stocks, small business stocks, which many of you hold as well. So some say this bill will increase the deficit and cause a financial crisis. Others, on the other side of the fence, say that the bill will boost economic activity, increasing the tax base and ultimately bringing in more tax revenue for the government and more prosperity for the average taxpayer. The jury's still out on this. I guess only time will tell. Either way, it's a good idea to stress test your portfolio with your planner. Maybe lean into small cap stocks or ETFs for growth, but make sure you're balanced with stable fixed income assets to help hedge inflation. So here are some practical takeaways for a smarter retirement. How do you make this all work for you? Here's your smarter way to retire playbook. Tweak your taxes, adjust your holdings for 2025 to match the new rates and deductions. Take a look at your financial model to see what impact the new law has on your probability of success. I think you'll be pleasantly surprised. And see how this might boost your retirement timeline. Make sure you max out your SALT deductions. If you're in a high tax state and you're not one of the excluded white collar professionals, itemize your taxes to make sure that you can claim up to the $40,000 SALT cap. Business owners should act now to use the 23% Section 199A deduction and immediately expense to reinvest in your business or your retirement accounts. And lock in your legacy. Update your estate plan, your wills and trusts to make sure that you can pass everything you've worked so hard to accumulate, pass that nest egg to your kids tax-free. Remember, we can pass up to $27 million tax-free per couple to your heirs now if you plan properly. Claim your car loan or senior deductions before they expire in 2028. Time is of the essence here. Rethink your green investments. Act fast on clean energy credits and maybe pivot to sectors like industrials that might benefit from new tax breaks. Stress test your portfolio with potentially a bigger deficit on the horizon. Work with your planner to balance growth and stability in your portfolio. And remember, you don't have to go it alone. Go to my website, leonardifamilywealthcare.com, grab our free 2025 tax planning checklist, and book a consultation with me if you want to get some personalized advice. So that's a wrap on the One Big Beautiful Bill Act. It's got some wins like lower taxes, estate planning perks, but it also has some traps like disappearing green credits and phase outs. Whether you're saving $3,000 or $11,000, let's make every dollar count towards your retirement dreams. If you have questions, reach out to me. Shoot me an email. You can find me at leonardifamilywealthcare.com. Next week, we'll look at how to tackle budgeting for these changes and keep your retirement on track. Until then, plan smart and retire happy. Thanks for listening and have a great day.
Securities and investment advisory services offered through Osaic Wealth, Inc., member FINRA SIPC. Osaic Wealth is separately owned, and other entities and/or marketing names, products, or services referenced here are independent of Osaic Wealth. The opinions expressed herein are for general information only and is not necessarily the opinions of Osaic Wealth or its representatives. Investing is subject to risk, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. It is not intended to provide specific advice or recommendations for any individual. Please consult your financial professional, attorney, or tax advisor with regard to your individual situation.